Todd, thank you so much for joining us today. I'm curious to know your perspective on what's occurring within the bond market. We saw the yield on the 10-year pull back a little bit with the latest consumer sentiment data. What are you paying attention to here in terms of flows?
Yeah, so we at Vetify are focused on the fixed income ETF flows. They're on pace to perhaps set another new record. We had a record in 2024. Over $130 billion has flowed in to fixed income ETFs as of mid-May. Where we've seen the money going into has been in the safe havens, the short-term treasury products. So SGov, which is an iShares product, BIL is a State Street product, 4% yields, limited interest rate risk. Money has really been hiding out there. But we at Vetify hosted an income strategy symposium about a week ago, and we saw indications that people are willing to take on a bit more risk.
Okay, they're willing to take on a bit more risk. And obviously, we've seen that in terms of the patterns this week following the news of the surprise news of the deal between the U.S. and China, or at least the, temporary trade truce that you saw that. Where are you seeing, when you look across fixed income, where are you seeing investors gravitate towards? Is it out of treasuries? Is it, I hear different talk about munis. Are you seeing more flows into munis, for instance?
So yeah, that survey that I mentioned, we conducted a survey at the Income Strategy Symposium that Vetify hosted, and we found that investors were more interested or more excited about municipal bond strategies and investment grade corporate bonds than in short-term treasuries. And we've seen some success and net inflows into municipal bond ETFs. Vanguard's VTEB, which is one of the largest of those municipal bond ETFs, has seen strong interest. And we've also seen engagement with actively managed municipal bond ETFs. So AllianceBernstein, or AB, has a popular fund that's been gaining traction. We've seen PIMCO with an ETF that's got a great ticker, MUNI, that has seen new inflows. And firms like Fidelity and Goldman Sachs have been expanding their product lineup in the last 12 months, focused on municipal bonds.
Okay, and then Todd, when it comes to what you're seeing with regard to the patterns in munis and and the survey data that you have, what's the reason behind the flows? Is it about yield? Is it about taxes, or something else?
So we asked investors what their focus for fixed income was, and it was really for stability and diversification. So those are two of the areas that fixed income offers. Yield is another one, and then total return potential. But we saw stability, and municipal bonds tend to have higher credit quality than their investment grade corporate bond alternatives. The tax-free universe has been quite healthy, both in product development in the ETF space, as well as what we've seen in obviously the individual bonds. So that's an area of focus. We're also seeing people who are interested in going out a little bit more on the risk spectrum, and CLOs has been an area of focus. So Eldridge has a product, CLOX, that we've been focused on at Vetify. They have a couple of products in the space. And then one of the firms we're keeping a closer eye on is PGIM. They are a leader within the CLO space. They've more recently entered into the ETF marketplace, but in the ETF, PAAA has been gaining some strong traction as of late.
Okay, I'm curious to know if you heard anything along these lines, or if you're seeing anything through your data, through your surveys, in terms of impact of the federal government doing the belt tightening, trying to address the deficit, and what it means for demand when it comes to munis.
So we didn't ask that specific question, but obviously if there's changes that are happening at the state level, then it could have an impact. We think that there's a merit in looking at an actively managed approach to municipal bond investing through ETFs, because you get the experts helping sort through that universe. So a firm like AllianceBernstein or PIMCO or Fidelity that I touched on earlier can help sort through that universe. An index-based product obviously can't do that. It holds the whole market.
Okay, and when you think about ETFs versus, say, mutual funds, especially bond ETFs, where's the balance? Where are you hearing the balance now?
So we're seeing ETFs increasingly gain share. People have tended to use mutual funds and actively manage mutual funds to get their fixed income exposure. But as we've seen more actively managed fixed income ETFs, the number of them has really accelerated in the past year. That is helping to encourage people to take a closer look at ETFs. With ETFs, you have greater liquidity. The cost tends to be cheaper. There's a number of fixed income ETFs that charge 3 basis points or less. And in fact, BNY Mellon has a product that is actually a zero fee expense ratio, BKAG. So we're seeing fixed income ETFs increasingly gain traction. Advisors and investors are starting to build those into their portfolio more than just mutual funds.
Okay, and then Todd, really quickly, looking ahead, what's the next big story when it comes to fixed income, or what patterns are you watching out for this year?
So we're intrigued. Obviously, the Fed has been on hold, but as the Fed continues to cut interest rates, will we see investors be more willing to take on interest rate risk, shift into more of those long-term duration products? That's an area that we're focused on at Verify.
Okay, all right. Thank you, Todd. Happy Friday to you. That's Todd Rosenbluth, head of research, Verify. Thanks so much.